In today's episode of the Daily Brief, I'll talk about two big stories. First, I explain why Europe is going through a poly crisis we all could see coming. Then I discuss about what our Minister of Petroleum and Natural Gas of India has to say about US sanction of Russian oil. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. I'm your host, Kashish Kapoor. Today is 28th January, Tuesday. You can find us on Spotify, Apple Podcasts, or wherever you consume your podcast. If you prefer video, you can listen along with interesting charts on YouTube. The Daily Brief is also available in Hindi, and if you like reading instead of watching or listening, you can sign up for our no spam newsletter for a quick rundown. All the links are in the comments. Let me start the first story with the question: how many superpowers does the world have? There's definitely one, the United States. There's also an obvious superpower in waiting, China. Chinese people may not have the same living standards as their Western peers, but when it comes to their national power, they are almost there. And then there's another superpower, though it hasn't lived up to the name in a very long time, Europe. On paper, Europe should have everything going for it. With a population of 440 million people, it represents 17% of global GDP. It boasts a variety of heavily industrialized economies and governments that can provide stellar outcomes in health, education, and climate policy. In the early 2000s, it was bigger than both United States and China, at least on a purchasing power parity basis. Yet, today it lags both as a distant third. It has muted international presence and declining clout. So today we ask, why has a continent-sized economic bloc with so much potential fallen so far behind? And the answer is rooted in complacency, structural contradictions, and external shocks. It all started with the neoliberal experiment. Europe's integration was a product of a neoliberal era. While neoliberalism has come to become a catch-all term for whatever people hate about capitalism, at its core, it believes in four freedoms: the freedom of movement of people, goods, capital, and information. This comes from a fundamentally cosmopolitan outlook where societies and nations mean very little, and all the world's people are the same. They're just competing to buy and sell things from each other. Everything else is a distraction. In this view, the world's governments would slowly stop trying to fight each other or push for any national priorities. They'd recede from people's lives and eventually become a mere providers of key infrastructure. This way of seeing the world was much popular 30 years ago than it is today. And because the EU was just being formed back then, the four neoliberal freedoms were baked into its very structure. In this new regime, Europe was conceptualized as a common market. While countries still had autonomy over provincial matters like education or defense, they ceded a great deal of control over its economic aspects of policy making. Everything from trade to competition to monetary policy was now to be run by a continent-wide bureaucracy based on neutral principles. This structure had its limitations. The Eurozone debt crisis was a product of these very limitations. European countries no longer controlled their own currencies and had strict limits on what their governments could spend. And so, when a crisis came about, they didn't have tools to respond. Many countries in the continent, like Portugal, Italy, Greece, and Spain, were hurt terribly by this lack of control. But while reforms followed, its overall structure remained the same because it simply worked too well, or at least at that time it did. During the good times, Europe had three big things going for it. First was openness to foreign trade. Foreign trade accounted for nearly half of Europe's GDP, much more than it did for the US, making it a global hub for commerce. Second was US security umbrella. The United States was an all-weather ally for Europe and underwrote a great deal of continent's defense costs. Europe, meanwhile, could redirect resources on economic and social development. And third, Russian cheap energy. Since the 1990s, Russia's fossil fuel industry has supplied affordable energy, which fueled Europe's industries and households. These were big advantages, and they maintained Europe's status as a global power center for decades. Unfortunately, these advantages also bred complacency. The continent slowly lost its competitive edge. Investment in infrastructure and education stagnated. Its productivity also tanked. The continent managed to get over this decline with the belief that with the right regulatory policies, it could maintain its strength. After all, Europe was arguably still the world's best market. Every company in the world wanted to sell in Europe. This created a point of leverage that Europe could use to maintain control over everyone else. Many good things came out of this, from global scrutiny over big tech's data policies to universal Type C charger. At the same time, however, this led to major regulatory overreach, making life hard for European businesses. And then it led to the polycrisis. Europe's reliance on its past successes left it ill prepared for tectonic shifts for the coming years. In the last decade, the continent has been hit by a series of crises, each one feeding into the other. The first was Brexit. When Britain withdrew from the EU, it raised fundamental questions about the union's role and purpose. The union's cohesion was shaken, and the opposition voices in other countries have since become so much louder. Second was the rise of Donald Trump. Trump broke from decades of precedents in his first term when he questioned the extension of America's security umbrella over Europe. While this security cover hasn't been withdrawn, it has caused a lot of uncertainty in Europe. Then came COVID 19. While the COVID 19 pandemic devastated the entire world, Europe was one of the worst hit regions in the world, especially in its early years. The economic and political impacts of the pandemic are still being felt in the continent. And finally, Russia's invasion of Ukraine. When Europeans pushed back against Russia's Ukrainian invasion, it severed Europe's access to cheap energy. Energy costs in Germany today are 3 to 5 times higher than in the US. As Europe struggled to emerge from these crises, the world had shifted. Many of its natural advantages had disappeared. It no longer had cheap energy, making its industry uncompetitive. It no longer had the certainty that America would protect its border. Instead, this dependence had become a problem. For instance, the United States was able to bully ASML, a crucial player in the chip supply chain, into cutting itself from China. There was also a broader geopolitical shift. The neoliberal consensus had weakened. Trade protections were coming up all over the world, and the other global superpowers, that is the US and China, were adopting muscular industrial policies. Europe's problem was suddenly impossible to deny. The continent was no longer as pivotal as it once was for international trade. And now, this is where Europe finds itself today. Many of the region's key economies are struggling. Germany is in a recession. France is caught in a political deadlock and is seeing its growth falter. Austria's economy shrinks amidst global crisis, while Belgium and Netherlands experience sluggish growth due to labor and energy shortages. Its main economic engines have eroded. Europe once led the world in advanced engineering and automotive manufacturing. China has now leapfrogged the continent. Germany's auto industry, for instance, once the envy of the world, faces a make or break year ahead. Venture capital investors no longer look towards Europe for new and innovative firms. The best of Europe's talent is shifted to the United States, and many of its manufacturing giants are moving production to the US. All of this calls for a major rethink. However, there's little hope for that happening. The continent's two anchors, that's France and Germany, are in severe economic and political turmoil. Germany is reeling from the shock of losing its industrial base to China and the United States. France's fiscal mismanagement has put it in a place where it can't even seem to pass a budget. Both are stuck in severe political deadlocks. They're unlikely to provide regional leadership anytime soon. For all these reasons, most of the world is deeply pessimistic about Europe's medium-term prospects. But that doesn't mean that continent can be written off just yet. There are industries that it did successfully safeguard, from aerospace to pharmaceuticals to green technology, and these retain their global importance. Last year's medical sensation Ozempic was a product of a European pharmaceutical giant, Novo Nordisk. The continent remains capable of more such surprises. Ironically, while many of Europe's champion economies struggle, the very countries that were hit the hardest by the Eurozone crisis, that is Portugal, Greece, Italy, and Spain, have now become economic bright spots. Europe survived the Eurozone crisis because of the Italian economist Mario Draghi. Draghi was appointed as the president of the ECB when the crisis struck, and he famously said that he was willing to do whatever it takes to pull Europe out. And he did, from debt restructuring to prolonged negative interest rates. It worked. Europe survived. Last year, he was brought in again to suggest a new roadmap for Europe during these troubling times. He published a 300 plus page report in September diagnosing Europe's problem and suggesting a package of reforms which covered everything from investments in AI to skilling to improving governance. As a whole, it pushed for a more united and cohesive Europe that could survive an unstable global landscape and act with the kind of muscularity the rest of the world has been moving towards. Now, there are some indications that Europe is listening. Some of Draghi's recommendations have already been included in the European Commission's next 5-year agenda. The body is currently considering an omnibus package that would simplify corporate reporting requirements. Will any of this actually work? Well, it's certainly not going to be easy. That said, only a fool would completely count the world's third superpower out. Now on to the next story. When United States slapped fresh sanctions on Russian oil earlier this month, it raised some eyebrows, especially in India where Russian crude now makes up over a third of country's total imports. These sanctions are aimed at disrupting Russia's oil revenues by targeting producers, tankers and even insurers. But for India, it's another test of how skillfully it can navigate an increasingly complicated energy landscape. Hardeep Singh Puri, Minister of Petroleum and Natural Gas, however, wants to reassure everyone.
My answer to your question is no need for any panic. I would say I wouldn't even characterize this as anxiety. This is the world we live in.
Speaking to NDTV Profit in an interview, Puri emphasized that India's energy security remains intact. There's plenty of oil in the world, and India is better positioned than most to secure its share. To understand the fuss, let's break it down. The US sanctions introduced on early in the Jan of this year don't just restrict Russian oil exports. They go after the logistics of how that oil reaches countries like India and China. This includes blacklisting tankers and insurers tied to the so-called shadow fleet Russia uses to transport this crude from their place to India and China. The goal is to squeeze Russian revenues further, making it harder for Moscow to fund its war in Ukraine. The catch for India here? These new sanctions complicate the availability of discounted Russian oil, which has been beneficial for Indian refineries since 2022 due to its lower cost. India started buying Russian oil in 2022 only because it was really cheap and has nothing to do with India's relation with Russia. Puri put it very bluntly. He said, if Russian oil is available at good discounts, we will buy it. If it's not, we will buy elsewhere. We buy oil from wherever we get it at the cheapest price. We covered the whole backstory of this one in one of our recent episodes titled US Sanctions on Russia Make Things Tough for India. Recently, the Directorate General of Shipping extended approvals for Russian insurers. Now, these names are very hard to pronounce, so I'll just skip that. They allowed them to cover tankers carrying Russian oil into Indian ports. This bypasses Western insurers who are now under sanctions. It's a clever move that keeps the supply chain flowing, at least for now. However, the US has set a deadline. Sanctioned Russian tankers can only offload their oil in India by February 27, leaving refiners scrabbling to finalize deals before that date. Beyond this, India will need an alternative shipping arrangement. But Puri remained unfazed. He said, the global oil market is not in a state of scarcity, pointing to increased production in countries like Brazil, Guyana, and Canada. One of the most significant issues tied to Russian crude is its impact on gross refining margins, that is GRMs, a key metric for refiners that measures the profitability of turning crude oil into finished products like petrol and diesel. Russian crude, particularly the Urals grade, has been a favorite for Indian refiners because of the favorable GRMs it provides. Russia crude's discount are shrinking from $8.5 per barrel last year to just $3 and $3.5 now. Alternative supplies like Middle East crude oil don't offer the same profitability. BPCL's Director of Finance recently revealed that Russian oil, which accounted for over 30% of BPCL's refining mix last year, will likely fall to around 20% by March. Gupta also pointed out that declining discounts are adding pressure to these refining margins, forcing Indian refiners to reassess their sourcing strategy. But the oil minister still seems quite optimistic. He mentioned that our refining capacity is growing rapidly. We're investing 80,000 crore rupees to expand it, ensuring that we're prepared for shifts in the global oil market. Puri pointed to India's growing exploration capabilities and its partnership with global players to boost domestic production. Petrobras is working with Oil India on offshore surveys in the Andaman Sea. BP is partnering with ONGC to rejuvenate old wells in Bombay High. These efforts, combined with expanding refining capacity, are aimed at reducing India's dependency on imports and bolstering long-term energy security. One of the most striking points Puri made was about India's unique leverage in the global oil market. Unlike some countries struggling to pay for their imports, India's strong economy and ability to pay upfront makes it a preferred buyer for oil exporters. This is a buyer's market. We have demand and we can pay, unlike many countries that are struggling financially. That's what he said. He also said a few other things that were quite interesting. Reflecting on the broader dynamics of the global oil market, he pointed to emerging suppliers like Guyana and Argentina as examples of how new sources are reshaping the landscape. Guyana's story in particularly stood out. They drilled 16 wells with no success. The 17th well hit the jackpot, oil and gas. And that's just the beginning. There are many other guanas waiting to be discovered, he said. Argentina too has joined India's import basket, marking another step in India's strategy to diversify its sources. We've gone from sourcing oil from 27 countries to 39. With Argentina coming on board, that number will only grow further, he added. He also mentioned India's oil companies have been delivering strong results despite the challenges. He highlighted BPCL's latest performance with the company reporting 20% profit growth year on year. HPCL posted an impressive 300% profit growth in the same period, showcasing how Indian refiners have managed to navigate global uncertainties. These companies are doing exceptionally well, even under challenging circumstances, said Puri. This focus on diversification also ties into India's green energy transition. While the shift to renewables is inevitable, he emphasized that it's not a process that happens overnight. He said the green transition is critical, but it has a wind in and wind out period. You don't just switch from fossil fuels to renewables. At the same time, he acknowledged that India's oil demand is unlikely to peak anytime soon. He said even the most conservative estimates suggest our demand will continue to grow until at least 2040 and possibly 2050. For now, India's strategy remains clear. Continue to secure affordable oil from diverse sources, expand domestic capabilities, and prepare for long term energy needs. As Puri put it, conflicts don't last forever, but even if they do, we will navigate around them. And those were the stories for today. Now, on to the tidbits. First, the FMCG sector faces rising input costs, with crude palm oil prices up 40% year on year and tea prices up 24%, squeezing margins. Rural demand grew 5% year on year, but urban demand lagged at 0.5%, reflecting inflation's impact on consumption and profitability. Next, India's composite PMI fell to 57.9 points in January 2025, with services slowing down to a 26-month low, while manufacturing hit a 6-month high of 58 points. Strong job creation provides a silver lining, but high inflation and competition challenge the services sector's outlook. And finally, China's January manufacturing PMI fell to 49.1, its lowest since August 2024, as weak domestic demand and unemployment weigh on growth. Despite $1 trillion trade surplus in 2024, export reliance and geopolitical tensions threaten recovery. And that's it for today. I'm your host Kashish Kapoor, and we'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.